Thank you for sticking around as we continue to explore the concept of inventory. And we're going to look at it from a perspective of the cost of sales, and we'll also discuss how to value inventory using the first in, first out, last in, first out, weighted average, and specific identification methods, which is where we'll probably spend the majority of our time on this conversation. So first, let's take a look at the inventory items and the cost of inventory. So inventory item, that's what we sell. Item is what we sell. That's straightforward. The merchandiser, the company that sells the physical goods, inventory item is an item that we sell. Very straightforward. Okay. We do take into consideration how it's getting to us, who's responsible for it, whether it's damaged or obsolete. Okay. So let's go through these. Good in transit. We talked very briefly about this in the previous chapter, and I'll quickly mention it again. Two terms: free on board shipping point and free on board destination. Free on board shipping point, the buyer is responsible for paying for the shipping and for the responsibility, meaning the insurance, of the goods while it's in transit. Free on board shipping point. The shipping point is from the seller in transit to the buyer, the destination. The buyer is responsible for it. Free on board destination is when the goods are, the responsibility is for the seller. Destination, meaning the seller is responsible for that inventory while it's in transit to its destination. They pay the fees for the shipping, and they also take care of the insurance. Sometimes goods might be sold on what we call consignment. If you've ever been to a secondhand store, like we call these consignment shops, okay? It's usually one store, and it's a bunch of like little stores within it, okay? Where people are trying to sell their stuff, okay? But they're not there. It's just the one store that manages this whole operation. We call that a consignment shop. Okay. It's where individuals like me will take stuff I want to sell to a consignment shop, and I'll say, hey, can you sell these for me? I'll say, yeah, I'll sell them for you. And they'll take a little cut of the pie, and they'll give the rest to me. Sounds nice, right? Here's how it works. Consigner is the owner of the goods. That's me. I'm the one trying to sell my stuff. I'm giving my stuff the consignment shop. We call that the consignee. They're going to sell it for me at their store. The merchandise belongs to me. So I'm responsible for that inventory. Consignor. The consignee never tells me what goods I have in inventory. That's my responsibility. That's how a consignment shop works. When I sell it at the consignment shop, they take a small piece because I used their store to sell it. Yeah. Damaged or obsolete goods. If it's damaged, it means it doesn't work. Okay, or it's partially damaged or mostly damaged. It doesn't work. I don't report damaged goods on my inventory because I can't sell it. Obsolete means it was replaced by something newer. Okay, iPhone 15 replaced iPhone 14. iPhone 14 is now obsolete. 15 replaced it. They're probably not going to keep selling the 14. Going to sell the 15. Obsolete. Technology, obviously, that happens a lot. We can still, however, sell obsolete goods like the iPhone 14 at what we call a realizable value, net realizable value. The net realizable value is the sales price minus the selling cost. It's usually worth a little less because it's obsolete. We record a loss when damage or obsolete occurs, meaning if the sales price is less than the selling cost, it's a loss. We know what inventory costs. This is pretty straightforward, but I want you to understand it. It's not just the purchase price. We purchase the red shirt, or Macy's. We purchase the red shirts from our vendor. Okay, the vendor charged us 15 cents a shirt. I'm sorry, 25 cents a shirt. 25 cents a shirt, we bought 100,000 of them from our vendor. So 25 cents a shirt plus other costs like shipping, storage, insurance, import duties, whatever else, minus any discounts. Okay, so cost minus discounts plus all of these other costs. That is our total inventory cost. See, it's never just the cost you paid for it, it's the cost plus all this other stuff. Hang on to it. Companies typically take inventory on a regular basis. We do a physical count usually at least once a year. So the next time you go to the shopping mall or you go to one of these big box retail stores like Best Buy or whatever, and you walk in there, you see these little tickets everywhere, these little stickers, doing inventory. Take a physical count of inventory at least once a year. And the reason why they do this is to match what they have on the shelves to what they have in their accounting system, their inventory system. As long as the two numbers match, it's good. If not, that means there's probably a shrinkage or a loss of that inventory. It's a good internal control process. Here is where I'm going to spend the most of our time talking today. Inventory costing methods. Inventory costing methods are really important because they help us to value our inventory properly. Okay. There are 4 methods that are commonly used. One is called specific identification. Specific identification is very commonly used for large unique items that have a serial number on them, that have a vehicle identification number on them, also known as a VIN, or a specific identification number on them. These are large unique items like vehicles, appliances, large unique things, specific identification. And the costs related to those specific identification is usually the purchase price plus some of those things we just talked about, the little extras. The second commonly used inventory costing method is called first in, first out. This is where we take the purchase price of what we purchased first in a sequence of purchases, and we sell that first. First in, first out. Think of a grocery store. A grocery store, they have the oldest stuff up front. Why? Because that's what they got in first. They want to get it out first. Because otherwise it expires. It goes bad. Perishable items, perishable store, places that sell perishable items, they use first in, first out. You want to get rid of that stuff first. Bought it in, get it out. In and out as quick as possible. That's what grocery stores do. Okay? Let's use what we call first in, first out, and we'll talk more about this. The third most commonly used method is called last in, first out. In a series of purchases, last batch of purchases of the inventory I got in, I'm going to sell that first. There's reasons why companies might do this, especially if the reason is the cost of that purchase higher than the other ones or lower than the other ones. Depends, right? We'll talk more about it. The last method that's commonly used is called weighted average. It's where we add up all the purchases that we've made, divide that by the number of purchases, in order to get the average of our purchases. This next slide helps me to very clearly explain the three methods: first in, first out, last in, first out, and weighted average. Specific identification one, don't worry so much about that because it is unique. It's for very large products that they have serial numbers or VIN numbers, and they're just they're specific. Yeah. Let's focus on these three. First in, first out. As I mentioned, a type of business that would use this would be like a grocery store. I want to get that first batch that they purchased in out first because it's going to expire. Okay? Perishable. First in, first out. On May 1st, the grocery store bought $45 worth of stuff. May 3rd, they purchased $65 worth of stuff. May 6th, $70 worth of stuff. I'm sure there's probably more beyond that. But let's just use these three purchases to make the example easy. I add up all my purchases, okay? $180. First in, first out means I'm going to sell that first purchase I made first. First in, first out. Okay, so I sell the $45 with the stuff first. First in, first out. On my income statement, it would look like this. Net sales, $100. I sold $100 worth of stuff on May 1st. Cost of goods sold, May 1st, $45. How did we get $45? First in, first out. Bought it May 1st, $45. Sold it May 1st, $45. Okay. That leaves me with a gross profit of $55. Net sales minus cost of goods sold equals gross profit. What about our balance sheet? What's our ending inventory? Well, I sold the $45. That means I only have May 3rd and May 6th inventory left. Ending balance. $65 plus $70 gives me an inventory balance of $135. Make sense so far? First in, first out? Yes? No, maybe? It's the most complex part, y'all. Good so far. Okay.
Yes, sir.
Oh, great. Okay, that's first in, first out. In my opinion, the easiest one to figure out. Besides weighted average, that one's pretty easy too. Where a lot of people struggle is last in, first out. Last in, first out tells us that we sell the last set of purchases first. Okay, why would you do that, you're asking? Depends on the type of business that you're running. For example, let's say you're Best Buy. You sell electronics. Okay? Electronics don't have expiration dates. Just because the computer you bought is a year old doesn't mean it's going to expire any faster. There's no expiration dates on electronics. Okay? There might be a lifespan. There's no expiration date. Last in, first out, Best Buy or companies that do not sell perishable goods probably use last in, first out. We got the inventory in. We kept getting more in. We just added onto the shelf. And then people buy it. You see? So, last in, first out. We made $100 in sales in the month. Or first part of the month, whatever. Our cost of goods sold is going to represent the last amount of purchases we made. In this example, $70 on May 6th. Cost of goods sold, 70. 100 net sales minus 70 cost of goods sold equals 30 gross profit. What's my ending inventory? My ending inventory are my first two purchases. 45 plus 65. That's what's left. That's the ending inventory balance. $110 in this example. That is how last in, first out works. It gets more complex, okay, because we didn't just make 3 purchases, we probably made 20 purchases throughout the month. So it gets a little bit more complex than this. But this just kind of shows you the very basics of how last in, first out works. The third inventory cost flow is called weighted average. By far, probably one of the simplest. Weighted average simply means that we add up all of our purchases and we divide by the number of purchases made. Here's how it works. May 1, $45. May 3rd, $65. May 6th, $70. I made $180 worth of purchases for these 3. I divide that by 3 purchases. It gives me a $60 average. I sold inventory. I use the average. In this case, $60. Cost of goods sold is going to be $60. At sales, I sold $100 worth of stuff this month. $60 cost of goods sold equals $40 gross profit. My ending inventory balance is $120. How is it $120? 60 times 2 left. Okay. $120. So you might be asking yourself, Dr. B, how do I know which one's the best one to use for my company? The answer is, it depends in the company that you're running. And the second answer is, it depends in the objective of the company. Here's what I mean by that. The more profit you have, the more tax you will pay. The more inventory you have, the more tax you will pay. You see what I'm getting at? Sometimes companies will select one of these based off of their desired outcome. If their goal is to reduce their taxable income, they're going to go with the one that gives them the least amount of gross profit. Or if their desire is to have less amount carrying balance on the balance sheet for inventory, they're going to go with that one. Okay, it really depends on the motivations of the company. But the law is, according to the generally accepted accounting principles, they have to use one of these. Okay, they cannot not do this. All right, very similar to what we learned in the last chapter. Beginning inventory plus purchases equals merchandise available for sale minus cost of goods sold plus ending inventory. See, this is the cost flow. Available for sale, we sell it, it becomes cost of goods sold. Otherwise, it becomes ending inventory. That's what we learned in the last chapter. And just like the last chapter, a company has to either use the perpetual inventory system or the periodic. That's how it works. That's how they track their inventory. And they use the inventory system to also work with first in, first out, last in, first out weighted average or specific identification. So in looking at that, we also need to remember and understand the physical flow of the cost. The balance sheet is going to represent the inventory. The income statement is going to represent cost of goods sold. These are what is shown from inventory effects. The physical flow of the inventory does not necessarily need to follow the same cost flow. That's where the perpetual inventory system comes into play when it interacts with first in, first out, last in, first out, or average cost. Here's where it gets a little confusing. So I want you to pay very close attention to these next few slides. And this is where Leland probably gets tripped up because Leland, I mean, this is like probably the most confusing part in my opinion.
Yeah, that's it. Because when I was doing, I think it was the chapter, was it 6 exam or the 5 exam? I can't. It was 6. Trying to understand this and then trying to figure things out, I just was confused.
Mm-hmm. I hear you. And this is probably the most confusing for anyone. The reason for that, Leland, is because depending on whether you're using last in, first out, or first in, first out, or weighted average, it's going to give you a different answer. Okay, and so I want us to walk through this piece by piece so we can all understand exactly how it breaks down. And I think that by doing that, it'll make it a little bit easier for us to get it. So let's look at the data, and we'll break it down, and we'll look at the three commonly used classifications. So let's take a look here. This is just the raw data before I show you what it looks like using the different methods. So August August 1st, we started our bicycle company. We sell bicycles, it looks like. So we purchased 10 bicycles from our vendor at $91 a piece. I'm sorry, beginning inventory. We started the month, August, 10 bicycles on the shelf, $91 a piece. That's what we purchased it at originally. It gives us a total acquired cost of $910. $910, and on the right side we see inventory, total inventory. So we started the month with 10. August 3rd, we purchased an additional 15 bicycles, $106. That meant we purchased $1,590 worth of bicycles on August 3rd. We add the 15 units to our existing 10. Now we're up to 25 units total on August 3rd. August 14th, we sold a bunch of bicycles. Sold 20 of them at a sale price of $130 a piece. Because we sold 20, that brings our inventory balance down to 5 on August 14th. We better purchase more, so we purchased more from our vendor. We purchased 20 more bicycles on August 17th. This time it cost us $115 a bike. That's a total cost of $2,300. That brings us back up to 25 bicycles available for sale on August 17th. August 28th, I purchased an additional 10 bicycles from my vendor. This time it cost $119 a bike. Total cost of $1,190 for that day, for that purchase of 10 bikes. That brings me to a total inventory balance, August 28th, of 35 bicycles. On August 30th, we had a sales rush. 23 bicycles were sold at $150 a piece. It left us an ending balance for the month of August of 12 units. Throughout the month of August, we went through 55 bicycles. Okay? We purchased a total of $5,990 worth of bicycles for the month of August. We sold 43 of those bicycles in the month of August. That's the data that we're starting with. It's important that we know that, because when we put this data into first in, first out, then last in, first out, and then weighted average, it'll make more sense. So, well, first let's look at specific identification. Specific identification is exactly as it sounds. It's unique. They're kind of like one-off. They have serial numbers on them. It's based off of the individual units. Simple. Very straightforward. Okay. So this approach, specific identification, it don't matter. We're just following the order that they came in at. We're just selling them. Okay. So this one's not as important. I will say that with specific identification is based off of the unique identifying information. So here's how it works. All right, just kind of break it down for you a little bit further. We look at the serial numbers on these bicycles, match them up with our internal sales documents, and we sell them accordingly. We bought 10 bikes at $91 a piece. We bought 15 bikes at $106 a piece. We bought 15 bikes at $115 a piece. We bought 3 bicycles at $119 a piece. On the sales side, we sold, total goods available for sale after all of our purchases. We have $5,990 of inventory available for sale. Our cost of goods sold represents, of course, what we sold and the cost accordingly. We sold through the first batch of bikes, second purchase, and a good amount of our third purchase. We sold 15, we had bought 20. And we sold 3 out of the 10 out of our last batch. So, inventory, August 17th, I had 5 left. Cost of goods sold was $115, giving me ending inventory of $575. August 28th, I had 7 left from that day. 10 minus 3, yeah. $119 a piece. Total of $833. Ending inventory had 12 bikes left at the end of the month. Total value of $1,408. That's specific identification. Yeah. Again, it's relatively straightforward, at least for specific identification. Sales are based off of relatively randomness. Now, let's look at first in, first out. Because, in my opinion, first in, first out, very straightforward, very easy to follow. And Leland, once we go through first in, first out, and then we go through last in, first out, you'll start to see the bigger picture. So here we go. First in, first out. August 1, beginning balance, bicycles, $91 a piece. That's $910. August 3rd, I purchased 15 more bikes at $106. I add that to my beginning balance. Beginning balance plus purchases, remember the formula. August 14th, I sold 20 bicycles. According to the first in, first out method, I sold my beginning balance first. That's what I had available first. 10 units at $91 a piece, that's $910. Sold all 10 of them on August 14th. First in, first to be sold. $910 I sold. I sold another 10 units from that first purchase. I purchased 15 bikes at $106. I sold 10 of them. Remember, I sold 20 units on that day. Sold through my beginning balance, plus I went into that first purchase. I sold 10 bikes at $106. $1,060 cost of goods sold, plus the $910 cost of goods sold. Total cost of goods sold for August 14th, $1,970. Let's look at the ending inventory. I got 5 bikes left at $106. Because remember, I sold through the beginning balance because that's what I started with. Plus, I sold through most of that first purchase, which tells me whatever I'm left with. In this case, I'm left with 5 bikes. I purchased them for $106 a piece. On August 3rd, gives me an inventory balance of $530. First in, first out. Then August 17th, purchased another 20 bikes at 115. Add that to my inventory. Push me up to 2,830. August 28th, I purchased some more bicycles, 10 of them at 119. Add that to my inventory. Push me up to 4,020. August 30th rolls around, I sell some bikes. Sold on that day. 23 bicycles, was it? Sold 5 and I sold 18. So yes, 3 bikes. Sold 23 bicycles on August 30th. That was a good day. According to the first in, first out method, first batch of the 23 bikes I sold on August 30th, those first 5 that I had from August 14th, that was part of my first purchase. Sold that first. First in, first out. 5 at 106. Cost of goods sold 530. I sold 18 bicycles at $115 a piece. That was for the cost of goods sold. That was from my August 17th purchase. I whittled down the balance. Because remember, I bought 20 bikes. That left me with 2 remaining from that batch, from that purchase. Cost of goods sold 2,600. My ending inventory balance 1,420. 5 of those bought at 115 back on August 17th. And the rest of them were from August 20th. I'm sorry, August 28th. Does that make sense?
Yes, sir. I understand it. Oh well, because according to first in, first out, you have to sell them all at 115. They all got to be the same 115 number at the end. Because I noticed that it's not 119.
Well, yeah, technically that would be in there too. So that one. Let me just double check now. I think we made 2 purchases at 115, don't we? Yeah, we purchased. Let's see here. We purchased 20 bikes at 115 back on August 17th. And so yes, yep. So those that 5 and 7 is a part of that original 20 bicycle purchase. Yeah. 8, 9, 10, 11, 12. Yeah. Yeah, because I purchased 20 bikes. I sold 18 of them at 515, right?
Yeah, that's why I was thinking like you should. It's like it's. I thought it'd be like 2 left from 115, and
It
then
should
the
be,
rest.
yeah, it should be 2. I think that's a typo.
But I was
Yeah.
confused because there's still 10 that you didn't sell. That's 119.
Yeah, that 10 should still be there too. Yeah. Yeah, that 10 should still be there too because we didn't even touch that balance. So yeah, I can see how that part could be confusing because yeah, this slide is not complete. It looks like. Looking at my notes. Wait a second. Plus the 2,600. Oh, okay. Yep. Yeah. So the income statement would reflect $4,570, and its ending inventory would be reported on the balance sheet as 1,420. So those amounts are correct, but it's just the other inventory is not. Yes, that is correct. Yeah, it should be 18 at 115. Yeah, that's correct. So yeah, this little part that should be down here the 10 at 119. It should be just below here. Price that's,
Okay.
yeah, just cut off, unfortunately. I think there's 31 days in August, right? So that's probably why. Okay, so that's first in, first out. Now let's move on to last in, first out, which is sometimes also equally as confusing. so let's break this one down. So here we have the same set of data. Beginning balance, $110 worth, 10 bikes, $91 a piece. August 3rd, just 15 bikes at $106 a piece. Add that to my inventory. August 14th, I made some sales. Now you'll notice the order. Last in, first out. I purchased 15 bikes on August 3rd. First part of the 20 bicycles I sold on August 14th was those 15 bikes at 106. It was the last in, so I sold it first. So I sold the 15 bikes first at 106, and then I sold 5 from my beginning balance. $91. Go ahead, Leland.
Um, just so I'm clear, because I'm trying to catch everything.
Sure.
For the last slide, was it supposed to be 2 times 115 and then 10 times 19? 119?
Yeah,
Because when I
that's
added
right.
those
That's
numbers
correct.
up, that's when I got 1,420.
Yeah, that's correct. You got it.
Okay, just making sure. Sorry.
Yeah, no, you're good. You're good. Um, so last in, first out. I'm going to sell those 15 bikes first. I purchased at 106 on August 3rd because they were the last ones to come in. So last in, first out. And then whatever is remaining, I'm going to take out of my beginning inventory balance. I started the month with 10, at $91 a piece. I sold 5 out of those 10. On August 14th, $91 a piece. Giving me a total cost of goods sold, August 14th, $2,045. Inventory balance, 5 units at $91 a piece. Because remember, I sold through all of the purchases I made on August 3rd. So 455 inventory balance on August 14th. Then I purchased another 20 bikes August 17th at 115. Add that to my inventory. August 28th, just 10 more bikes at 119. Add that to my inventory. August 30th, I sold 23 bicycles. Okay. Last in, first out. So the last purchases I had come in were 10 bikes at 119. So sell those first. Last in, first out. 10 at 119. It's 1,190. Cost of goods sold. The remaining 13 bicycles comes from the earlier purchases. So the 13 bikes from there would come from the purchase I made on August 17th. I purchased 20 bikes, 115. August 30th, I sold 13 of that batch of bikes. So 13 at 115. 1,495 would be the other part of cost of goods sold. Add those two together to get 2,685 cost of goods sold for August 30th. And looking at the ending inventory balance, I got 7 bikes remaining from the August 17th purchase. Okay. I got 5 bikes remaining from my beginning balance. You see? Inventory balance 1,260. Total cost of goods sold for the month, $4,730. Makes sense?
Yes. So in LIFO, typically the inventory balance will be lower than the other ones.
Typically, yeah. That's yeah. That's about right. That's
Because
about what.
usually they're trying to sell the later stuff probably is more expensive than the earlier stuff,
In
which
most
would
cases, yeah.
okay.
Especially with things like inflation. Yeah, that's true. Yeah, absolutely. Good point. And again, the reason why some companies would want this is because of the carrying costs of inventory, and they also want to reduce the overall net income. Of course, the easiest one, the weighted average. So number of purchase, total cost of goods sold divided by number of purchases. So in this case, uh, for each time that we made sales, so the way it works is that we would take our total cost of goods sold divided by the number of purchases. So we have August 14th, we made our first sale, sold 20 bikes, $100 a piece, $2,000. Cost of goods sold. And so let's see, where are we at? Cost of goods available for sale, 2,500 divided by 25 bikes at the time of that sale equals a weighted average cost per unit of $100. That's where that $100 came from. So that's the best way to remember that. August 17th, that average changed because of the additional purchases that we made August 17th. Cost of goods available for sale on August 17th was 2,800 divided by the 25 bicycles that we have available at that time, giving the new average of $112. So the best way to think about the weighted average is it's a rolling average. August 28th, we more purchases, right? Cost goods available for sale, 3,990 divided by 35 bicycles at that time available for sale gives us a new weighted average on August 28th of 114 per bike. August 30th, we sold 23 bikes at $114 per bike was our average cost. You can see, of course, the difference with cost of goods sold. Questions on weighted average? Doing okay? One more slide to this part, I think. Questions on weighted average? It's a moving average. It's a way to think about that.
Okay, so you just do the average every single time you come down.
Yeah, exactly. So every time you make a
Oh,
purchase,
so you don't do it at the end.
no,
You do
no.
it.
Yeah,
Okay.
you want to do it as you're moving through
That's how I kept getting messed up.
yeah, because you're purchasing more, right? So like
Yeah.
so what we're doing is we're taking um, the inventory value and we're dividing it by the number of bikes available for sale on that day.
On
So
that day.
exactly, yep, on that day exactly. So pretty much every day that you're making a purchase, you're updating
And
that
then at the end you should come with
that
the average for the whole. Okay, got it. Got it.
exactly. Yep, cool. Great. Awesome. We're doing good. Very good. So, so again, looking at the three options. I mean, there's four. There's the specific identification. But looking at three, so So what's the effect on the financial statements? You might be wondering. So first in, first out, the ending inventory approximates it's about the closest approximation to its actual cost or its current cost. Last in, first out, the cost of goods sold on the income statement is approximate to the current cost. And the weighted average, it smooths it all out, right? It averages it. That's the way I like to think about it. So if we look at our example that we just worked through, looking at those three different methods, well, really four, we can see the effect on cost of goods sold and inventory, and what it does to our gross profit, right? So the sales were the same. The sales we made the same amount in sales regardless of the type of method we used, $6,050 in sales. But the cost of goods sold was what was different. And in looking at this, we can see that first in, first out had the lowest cost of goods sold amount, which gave us the highest gross profit. It also gave us highest inventory balance. So, on the lower side, we had let's see here. On the lower side for gross profit, we had last in, first out, which also gave us the lowest inventory balance. So again, and thinking about, well, what's the best method to select? It depends. It depends on what the ultimate goal of the company is. Do they want to show a higher gross profit, or do they want to have lower taxable income? Whatever. It depends.
So FIFO, you would have a higher net income.
Yeah. Ultimately, you would have a higher net income using FIFO and a lower one using LIFO. Mm-hmm.
You said LIFO would have. You said they want to have a lower. They want to have a lower gross
Taxable
profit.
income. Yeah,
Yeah. Okay.
they want
So
to have a
they have
lower
to pay
taxable
less
income.
taxes. Okay, got it.
Exactly. Yeah. So last and first out will give them a lower taxable income
Got it.
because the gross profit will be less. And so, and that's what's most interesting is the effect on taxes, right? So the IRS requires for tax reporting purposes to use LIFO. It's the lowest taxable income. And so for reporting reasons for taxes, you would use LIFO, but for your financial statements, your balance sheet, income statement, you might want to go with first in, first out, because if you're trying to attract new investors or whatever the case is, having a higher profit looks good. Yeah.
So you couldn't. Basically, what this rule says is you can't use FIFO for one and then LIFO for the other, because that's.
Well, you could, but
Wouldn't that be
regardless of what you do, when it comes to filing your taxes for the company,
yeah.
you have to use a LIFO.
Okay.
But when it comes to valuation of the company, which is something totally different, you could use FIFO or weighted average or whatever. Yeah. But as long as you convert it to LIFO for tax reporting, the IRS doesn't care. Yeah, that's an advanced accounting advanced accounting course kind of question, but yeah, that's the reason why companies do a lot of things that are tax driven. One of the other things you should know about is called the lower cost or market. Lower cost of market tells us that the inventory must be reported at its market value when the market is lower than its cost. Okay, and the cost refers to the cost of replacement, not necessarily the cost of selling product. three ways that we could apply this. One is separately to each individual item, or we could do it to major categories or the entire inventory for the company. The lower cost of market is simply which is lower, the cost or the market. Yeah, it's what the name implies. And so whatever is lower is what we record as our market value. So that's the whole reason why we go through that low cost of market thing. We can use the type of information that the stuff we work through to understand whether our financial statements are understated or overstated when it comes to our inventory. We can make adjustments accordingly. That's what this kind of summarizes. And of course, it wouldn't be an accounting class without at least a couple of ratios, right? So since we talked about inventory, one of the most important ones is called the inventory turnover. This tells me how many times I could sell my inventory during an accounting period. It helps me. Also tells me how well management is controlling their assets. Yeah, to sell through their inventory. The way we do that is we take cost of goods sold divided by average inventory. Remember, one of the first things I said when we talked about ratios in this course was to find the average of pretty much anything, take the beginning balance plus the ending balance divided by 2 to find the average. Another ratio is called the days sales and inventory. This tells me how many days the inventory sits on the shelves before we sell through it. Days sales and inventory. Take ending inventory divided by cost of goods sold times 365 days. Days sales and inventory. How long is it sitting on the shelf for? Let's go what that tells you. And of course, and we talked about this part, the effects of inventory following the physical flow. Balance sheet's going to show you ending inventory. Income statement's going to show you cost of goods sold. We worked through that awesome example that I really enjoyed, and we saw the differences between specific identification, first in, first out, best in, first out, and we talked about weighted average. And I thought that working through that bicycle example, I think was really helpful. And then, of course, one of the last things that we look at is inventory estimation. In retail, it's always good to estimate where your inventory stands at all points in its stage because of the unknowns. Yeah, so that's why we go through estimation processes. We're not going to go too deep in that course. And that, my friends, is the end of our discussion today on inventory. Which is what this chapter really should have been called, inventory evaluation. Are there any comments, questions, concerns about anything we talked about today?
No, Professor. Those last couple slides were just more examples of the stuff from what we just discussed before.
Exactly. Yeah, they're part of the appendix. Yeah.
Okay. Yeah. So if just to help you further. Okay. Got
exactly. It. Yeah. They just kind of help to further the thought process.
Cool. This helped a lot because I actually understand what I'm looking at now.
Awesome. Very cool. That's the whole idea. That's why I do what I do. Okay, so just to recap, what you should be working on for class on Thursday is go into the classroom, go to instructional materials under week 3. There's a lot going on, isn't there? So, engage and explore for week 3. We have one thing to do there. Inventory valuation, the video annotation using hypothesis, just like the previous week. And then you have your Chapter 5 and Chapter 6 quiz. So really, in comparison, week 3 is a little easier in terms of the amount of stuff you have to do. At least I think so. Again, if you're late with anything as of right now, please make sure you get it submitted. Please, please, please. You got to get caught up just as quickly as you can, because falling behind in this class is very, very dangerous. So please make sure that you submit all of your late work just as quick as you can. And with that, thank you all so much for your time today. I really appreciate all of you. If you need anything, you can email me, call me, set up office hours. You know I'm always going to be here for you. So I got your back no matter what. So thank you all again. Appreciate you. Enjoy the rest of your night. Thank you so much for your time. Take care.
All right,
Bye.
Professor. See you next.